Hey, welcome to the show today. Now, KiwiSaver is one of the most effective ways you can fund some of your retirement needs in New Zealand. Being so effective, you'd assume that we'd all take it quite seriously, right? Well, not exactly. Many self-employed people, for example, have sat on the sidelines as they feel disadvantaged from the start, seeing how there's no employer matching their contributions. There's also still a truckload of KiwiSaver members who haven't bothered yet to make an active decision on which funder provider is right for them. That can cost people hundreds of thousands of dollars in retirement alone. But added to this is the fact that many of us still aren't investing an amount sufficient to fund a retirement which is above average. So in today's show, Rupert Carlyon is going to walk us through how KiwiSaver works. And we're also taking a deep dive into active versus passive management. Rupert is with Kura Wealth, a KiwiSaver fund manager. Now, what is a fund manager? A fund manager makes investment decisions on behalf of its members. That's you, and that's me. So, on to a few disclaimers before we go any further. Number one, this isn't financial advice. You know that already, so don't take any action on any of the content mentioned today. Number two, I don't want you to assume that one strategy is better than the other with respect to KiwiSaver. What's right for you depends on how your other investments are set up. The main thing with this episode is to keep an open mind. Whatever you think already, try to see the other side. And number three, Koura Wealth is a partner of the NZ Everyday Investor. That means they contribute towards some of the costs incurred to bring this show to you. Okay, disclaimer's done, but before I start, I'd like to acknowledge another partner of ours, Hatch. Now, Hatch is an online investment platform for Kiwis keen to invest in the US share market. Check out the link in the show notes for a special offer to our audience for all new account holders with Hatch. That's it for me. Let's get started on the show.
Welcome to the show today. Now, Rupert Carlyon is my guest today. Thanks, Rupert.
Hi, Darcy. Thank you for having me.
Now, for a bit of background, Rupert, you are founder at Kura KiwiSaver, and we've had you on the show a few times before, so if people have been listening for a while, they know the background a little bit, but just a quick snapshot. What is Kura KiwiSaver? What do you guys do?
So Koura is a digital KiwiSaver specialist. We have taken the view that KiwiSaver is a market that isn't quite working. People need more help selecting KiwiSaver funds, more help in getting the right set of contributions, basically to avoid people having nasty surprises when they turn 65 and KiwiSaver isn't enough. So we were the first in the market to go and build a digital advice product, and we believe we've got the leading digital advice product in New Zealand, and it's all about setting the right set of tools to help people make better KiwiSaver decisions. KiwiSaver is all about making sure you're in the right type of fund. The wrong asset allocation and the wrong type of fund is going to cost the average Kiwi hundreds of thousands of dollars. Yeah. That's really scary when you think 20% of people still sit in a default fund. That's the most important part. Yep. Understanding contribution rates. We did a survey. 75% of people expect to retire and have KiwiSaver as the majority of their KiwiSaver when they only contribute 3%. And what do we know? You need to be contributing kind of closer to 10%. And so our job as a KiwiSaver, or I believe, and I'm probably in the minority here, our job as a KiwiSaver provider is to help you, my clients, make better decisions and make sure at least they're going with their eyes wide open. Understand that they have chosen this fund. If they've chosen the fund we recommend, great. If they haven't, we're going to tell you why and what's kind of not there. Okay. We're going to tell you up front what kind of your contribution rates are going to give you. Are you going to have enough to retire and maintain your lifestyle, or are you not? And look, we can't force people to make decisions, but I think the difference between what we do and others is we're at least trying to open people's eyes so that they can make informed decisions.
Not just at the start, but on an ongoing
manner. And look, that's probably one of the biggest misnomers of KiwiSaver, that it's a set and forget product. So for us, being a true advisor, it's all about checking in at least annually. We'll kind of make sure that we're not just going to forget about you once you signed up. There's an ongoing process to try and make sure you stay in the right type of fund and make sure you're continually aware of kind of where your KiwiSaver is going.
Okay. Now, for those of us who are maybe not so familiar with how KiwiSaver works, I'm not necessarily investing in you. No. I'm investing in the quality of the decisions that you might make, but where does that money actually go?
Yeah, so I'll start right at the top because this is something not many people understand. So as the primary way of contributing to KiwiSaver is through your employer. So you'll contribute 3% or 3, 4, 6, 8 or 10% of your wages, and your employer will pay that directly to the IRD. The employer should, if they're a good employer, they will match that and pay an extra 3%. And so that money goes from your employer to the IRD, and then from the IRD, they'll pay it into a trustee account that Kura kind of manages.
This is also known as a supervisor, correct?
Supervisor. Mm-hmm. So we never have access to that money. We never touch that money, but we then direct it. So fundamentally, if you've signed up to a Kura KiwiSaver scheme, you'll be invested in one of our, or 4 or 5 or 6 of our 6 different funds. And then once it's in that fund, we then direct that and invest in different components, right? So Kura, we have 6 funds, each individual sector funds to make up what we call a balanced portfolio. Our job as manager of those funds is to make decisions to ensure that we get the best possible return for each of those funds for our underlying investors. You raised a really good question of the risks and will this kind of, am I ever going to lose my money out of this structure? And the really short answer is no. And I can be extremely categorical on that. There are 2 layers of protection, right? One is all of your money is paid into a trust account, which is held in the name of a supervisor. Super technical language, which basically means we can't touch the money. We never see that money. And so therefore, it's completely not related to the fund manager. So, and then the second reason why you will never lose all of your money in KiwiSaver is KiwiSaver is set up as a long-term investment. And so therefore we invest in the stock market, we invest in, which can be risky, but fundamentally a good KiwiSaver manager, and to be fair, most KiwiSaver managers are good KiwiSaver managers, are investing in balanced portfolios. And that means that you've got investments across lots of different markets, lots of different companies. And so for your KiwiSaver fund to go to zero, the markets have got to go to zero. And trust me, if the stock markets go to zero, we've got much bigger problems than your KiwiSaver.
We're running for the hills.
We are, right?
We've got our bug out bag and we're hunkering down.
Well, we are.
Yeah.
It's kind of...
Zombie apocalypse. It's what we always dream about. It's
Where
what
would
I
you
always
go?
dream about, right? It's what happens when the zombies come.
Oh, exactly. I just kind of run straight up to the lakes above Nelson and hide there for months.
Yeah. But yeah, that's the thing, right? Like I think a lot of us think, when there's this awakening that, hey, KiwiSaver is actually pretty cool. Oh, it's actually investing in the share market. Oh, I don't like shares. I'm going to stay away. Because what happens if everything just crashes? I'm going to lose all my money. But you're not going to lose it because it's long-term investment, which means you can't even cash it out if you wanted to.
Exactly.
It's stuck in there. But also in the long term, companies don't go to zero. Some of them do.
So some do, right?
But if it's allocated properly.
But I look at our different sets of funds, right? So our New Zealand equity fund. Our New Zealand equity fund is, New Zealand's a very small market, but we've still got 45 different investments in that fund. And effectively, for that fund to go to zero, the entire New Zealand stock market would have to go to zero. Our US equities fund, that's got 700 individual investments in it, and there will be companies that go bust in there. Don't get me wrong, right?
Yeah.
That's capitalism. Capitalism, you expect a decent chunk of companies to go bust every year, but you also expect a whole lot of companies to absolutely shoot the lights out every year as well. And it's all about having the diversification to kind of go through that. And so that's why the way we always invest, and to be fair, most KiwiSaver managers do this as well, is saying, hey, look, we've got an allocation to New Zealand. Within New Zealand, we've got a diversified kind of portfolio there, an allocation to the US, an allocation to the rest of the world markets, an allocation to emerging markets, an allocation into fixed interest. And so fundamentally what that means is if a company goes bust, I don't really care because I've got 3,000 companies sitting in my portfolio. Yeah. If a region goes horrible, so like Japan, which went bad for 20 years and didn't recover, again, Japan for me is only worth 5-6% of my portfolio. So it's ugly.
Eggs in different baskets.
But it's always going to come back, right? And then my US portfolio is going to do really strong. So that's the beauty about KiwiSaver, and that's the beauty about what we do is the diversification and allows us to spread our risks, which means that you will never go to zero because you're not exposed to a single piece. It's not like my son with his portfolio that thinks he's smashing the lights out because he's invested in GameStop and Air New Zealand, and he thinks that that's all he needs to do. Yeah. Those two could go to zero. Yeah. That's a very different type of investing to what we do in KiwiSaver.
That's right. And that's a good sort of conversation around diversification versus concentration. What I'd love to focus on would be the passive style, right? So every investment strategy or style can be described in certain ways, but we basically have, kind of like a spectrum of active management and passive management. Do you want to explain to us what the difference is between the two?
Yeah, so passive investing is when you invest systematically. So generally what that means is you will follow an index or you will follow some form of theory. And then active investing is where every single investment decision is made with a whole lot of thought. And by that what I mean is you're going to sit there and say, oh, Air New Zealand's looking quite cheap today because something's happened and therefore I'm going to go buy. Or you might kind of go, oh, the US kind of Jerome Powell last night, he was talking about inflation expectations coming right down, therefore the US dollar weakened, so I'm going to go buy the US dollar. So it's all about extensive research to make decisions.
Hands-on, getting your brain dirty. You're thinking things through a little bit.
Very, very much, right? So when you watch the movies, the kind of all the Wall Street stuff, that's all active management. That's all kind of people buy high, sell low. That is what active is about. And the epitome of active is probably hedge funds, who kind of completely disalign themselves with the markets, and taking the view that they'll just take big, heavy bets.
Contrarian bets, yeah.
Exactly.
Yeah.
So passive, when I describe systematic, we're going to go, look, we're going to invest in the New Zealand equities market, right? So we're going to choose we've got a portfolio that we choose the Morningstar index, we make some adjustments to adjust for risk, and then we invest according to that. So if the market's up 2% tomorrow, we're going to buy. If the markets are down 2%, we're still going to buy. And the theory behind passive investing is that over the medium term, investors very, very, very rarely outperform the market. So the evidence is pretty clear on this. It's largely out of the US, but out of the US, I think on average about 90% of funds underperform the market. So therefore they would have been better off taking a market exposure.
Wow. Yeah.
The other bit that's really interesting about passive funds, about the reason why active funds are getting worse is that the research also shows a top performing fund. So if you've kind of managed to pick a fund that's done really, really well over the last 2, 3, 4 years, a fund that is top quartile performance over a 5-year period, less than 15% of those funds will be top quartile again in the next 5-year period. So what they've done is they've gone and they've taken an active strategy and they've implemented that, and that's worked really well in a set of market conditions. But when the market turns, that might not work so well.
It's kind of like having a theory or a model to understand something.
Completely.
It works for a season, but it's really hard if you have a static model to have success with that long-term, right?
It's a little bit like sitting there going, well, so the big question I'd ask the investors that listening is saying, how would Jonah Lomu go if he was put into the kind of All Blacks today? The style and how he came in and he just completely changed the game because he was innovative about what he did and how he did things. Would that still be the same thing today? And investing isn't that different, right? People have strengths, they have skills, they have a way of doing things. And over a 5 or a 10-year period, the market can change a huge amount, but you've still got the same person doing the same thing. So NZ Super talk about this really well. They've taken the view, because NZ Super are 100% passive of their international portfolio.
Okay.
Their international equities portfolio.
Yeah.
And they've taken the view that, there are active managers that outperform. But picking which one's going to outperform is just too hard.
Yeah.
And they don't believe they've got the capability or skill set to pick which active managers are going to outperform, which is why they've taken the approach of internationally, they'll go passive.
Right.
Another really good example of the same thing. Back in 2007, there's a very famous bet made between Warren Buffett and a hedge fund manager. Yeah. Warren Buffett said to the hedge fund manager, look, pick 15 hedge funds, create yourself a basket. That gives you enough to manage your risk because you've got 15 rather than just one.
Yeah.
I'll put all my money in the Vanguard S&P 500.
Yeah.
At the end of the 10-year period, whoever's got more money, well, kind of it's $1 million bet either way. And of course, I think by 2011, the hedge fund guys had given up.
Yeah.
Because the outperformance from just the pure S&P was so much. And so that's a really good example of hedge funds, right? The titans of the finance, kind of the financial markets, supposedly. And they're taking the best of the best But after 4 or 5 years, they'd already bummed out.
Which is awkward. Because naturally, I think that maybe this is pride. Maybe it is, right?
Yeah.
Naturally, I think, well, if I'm smart enough, if I have enough intuition, maybe I can pick the next one. Maybe I can, right? So it feels hard to come to grips with the fact that, hey, maybe that theory isn't actually supported by the data, so maybe I need to change my theory. Because what you're saying is that there's a lot of data to support that a passive strategy is actually better. So if that's true, I need to adjust my paradigm to that truth, right?
But you've also this theory has been around for a long time, and it's over the last kind of 5 to 10 years, it's got a lot stronger, right? But one of the big shifts in finance land. So when you and I grew up and kind of started our careers in the financial markets, it was easy to get information asymmetries. Right. So
and what you mean by that is it's not uniformly distributed, right?
It's not uniform. Well, yeah, I need to be very careful what I say here because I'm not talking about insider trading. I'm kind of close to that. But it's kind of saying
legal insider trading.
Yeah, right? But it's sitting there going, hey, look, when I started kind of around the financial markets, right? We didn't even have emails on our phones.
Yeah.
Everything was done kind of. We'd only just started taking orders on the via email.
Yeah.
And so you talk to the CFO or CEO of a company, and he'd kind of tell you a whole lot of stuff, and you're like, okay, awesome. Then you're going to go peddle that information to your clients, and that's all fine. That's how the financial markets work. Whereas now,
everything's sped up, right?
That information is going to be on social media, and that's going to be there within seconds.
So the efficient market hypothesis, which is kind of loosely what we're talking about here.
Exactly.
All information is widely known and available and almost instantaneous. So the price of anything that you're investigating is already taken into consideration, all known information. Right?
Exactly, right? Yeah. So information, the cost of information has become so low that it's now available to everyone. And I think that is one of the big reasons why active investing has got so much harder, because you can't, you might have the smartest guys in the room, but fundamentally now they're all crunching exactly the same sets of information.
Yeah.
Whereas 20 years ago, they weren't crunching the same information. The smartest guys in the room for the hedge funds were crunching a very different set of information to the standard mutual fund or the retail investor at home.
Yeah, interesting. It's an interesting concept.
It's fascinating, right?
I think about this a lot, right? Because again, naturally, I think, well, surely there is still a role for intuition, gut feel, but you have to acknowledge the fact that things are changing.
And there is, right? And look, and I think, and it's really interesting, right? There will always be. So there are some reasons why I think active can be quite interesting, right? So we talk a lot to, not so much in the KiwiSaver space, but in the non-KiwiSaver space, we talk to people about what's really good is to build yourself a core portfolio of passive funds. And then you might choose a little bit of active funds or even individuals to sit beside it, because they might actually outperform.
It's flavoring.
It's flavoring, right?
But your core, ideally, is wise to be. It's wise to be passive. You don't have to, but it makes sense, right?
Yeah.
Low cost, core, well diversified, passive approach. Set and forget. It's going to give you the market. That should be the majority.
And we know that's probably going to do well. It's just hard to get excited about that, right?
Yeah, that coring is boring.
It's really hard. It's hard, but I mean, that's the problem, right? With money, generally, the slow, steady approach is what works the best.
And the more you fiddle with it, the more trouble.
And that's kind of why I think there is. And so there is a bit of a balance there.
Yeah.
Personally, there's also a conversation to be had about where you are active and where you are passive.
So I want to talk more about that. Just so I get this really clear in my mind, though. So I'm a KiwiSaver member.
Yep.
The money goes to the supervisor after the IRD, and the fund manager directs it, and off it goes into various different funds. And the way it works with you guys is that those funds are passively managed, well diversified. The art is in the selection of what mix of those funds, depending on who the individual is. There's effectively an overlay to help with the selection of what portion in those funds, right? And you guys do it really well using digital advice tools. That's in a sense, that's like almost like an active overlay, isn't it? In a sense, right?
It is in a sense. I think there's also a deferred where, well, like everything in finance, nothing's clear cut.
Yeah, that's right. A lot of murkiness.
A lot of murkiness, and how often you change it depending on how often you move between active and passive. It's kind of, I don't know the answer to that, and that's why my view is we've all got our styles and we all do what we do, and that's all that matters, right? But that's why you kind of go, even though you might have a passively managed fund, you've still got a portfolio manager that's going to be sitting there going, well, do I have the right degree of ESG? Or do we want a large cap only set of funds, or do we want a total market set of funds? There are a huge number of decisions that need to be made and constantly reviewed. But just because we're not making or hedging is another really big decision that we're constantly reviewing, right? What level of hedging, how much exposure do we want to the New Zealand market versus the US market?
Yeah. So what I'm hearing though is passive doesn't mean you're just sitting around doing nothing. No. That's probably really important to point out, right? Because in some people's minds, they might just be thinking, well, I'm investing via this scheme and nobody's at the wheel. We're on autopilot and hopefully it'll work out well. But that's not the case.
That's not the case, right? Are we going to make changes if the market tanks? No, we will not respond to market changes because we take the view that the market is, we need to be strategic, and we take strategic asset allocation decisions, which we expect to last 6, 12, 24 months or longer.
Yeah. That
means we're going to constantly review those versus tactical decisions, which are, hey, look, I'm scared about what's happening at the moment. Markets are overvalued, so I'm going to kind of significantly reduce my holdings, move to cash. That's what I call a tactical decision.
Okay.
We won't do that.
Okay.
We will make ongoing strategic decisions to make sure that the strategy that we're employing is the way to create the best value for our clients over the medium term. Yeah. And that's all based on the evidence and the academic evidence that we kind of spend our lives reviewing. Because what I believe and what we employ at Koura is KiwiSaver is a long-term investment. KiwiSaver is all setting yourself up for retirement. Yeah. And therefore, what we need to be as a portfolio manager and as a fund manager for our clients, we believe asset allocation and getting the portfolio theory right is by far and away the smartest way where we can create the best value for our clients.
I want you to break that down a little bit for me, and listeners can check out the episode that we did about asset allocation. I'll put a link in the show notes. But you were telling me this before we started, that the majority of the win or the majority of the benefit is in the asset allocation.
Right? If you think about it, managing a KiwiSaver fund, there are really 3 different layers of decisions that you need to make, right? Or 4. So you're going to sit there, and the first decision you're going to make is you're going to go the split between growth and income assets.
Okay.
So by growth assets, that generally means equities, so shares, private equity investments, property, kind of an income.
Yeah.
Versus income assets, and that's kind of cash, fixed term deposits, and bonds, all of that kind of stuff, right? So that's the first decision you're going to make. And that's a really, really, really important decision, right? Because you're going to go, the expected return on cash is 1%. The expected return on fixed income, 2%. The expected return on equities is 5 to 6%. But equities has got plus or minus 30 or 40% in a year, whereas cash has got 0%.
Almost nothing.
So
the volatility goes up as you move along that spectrum.
Yeah. So that's why that's going to drive, where you sit on that spectrum, going to drive the majority of your returns. So the asset allocation, and it's about figuring out how much risk you can afford to take. Because if you take too much, everyone listening to this, you might just say, well, why don't I just put my whole money into equities? It's the growth assets. And the reason is not everyone can handle the volatility. So that's why for us it's about saying, so that's why the first and most important decision is always about what is the right split of assets for that person. And it's not taking the easy answer, which is just up their risk. Yeah. It's about figuring out how much risk can that person take. So decision number 2 is you're going to go a regional split. How much money do I want in New Zealand? Yeah. And how much money do I want in the US or different regions around the world? Because, we could go, but we live in New Zealand, we love New Zealand, it's done really well over the last 10, 15 years. But then you're going to go, well, but imagine if China turned off the taps. Yeah. Imagine if China says, we're not going to take your logs or your milk anymore, and the New Zealand economy just craters. So it's about kind of going, or we might go overweight in another different market. So it's about, for us, it's about setting up the different asset allocation models to create what we think is a sensible, sustainable, long-term regional split to give us good long-term returns and good long-term diversification. Next part is currency. We've taken the view that a 70% hedging ratio is the right approach,
Okay.
and we've taken that view because there are costs involved in hedging. There always are.
Yeah.
And we've kind of did all of the detailed analysis.
Can you quickly break that down? So 70% of the currency is hedged, which means what?
So the US equity markets might deliver a return of 20% in a year. Just for the simplicity of numbers, that means if I had invested and I was a US dollar investor, I'd get a 20% return. If over that same period, the New Zealand dollar strengthens by 50%, that means 50% of that return is eaten away. If I'm a New Zealand dollar investor, 50% of the return is eaten away by that strengthening of the New Zealand dollar. So as a New Zealand dollar investor, I'm only going to get a 10% return. So when I say a 70% hedged, what that means is I'm going to get 70% of the return of the US dollars equivalent. So that means I'm going to take, so we said 20%, so 70% of 20%.
You should have picked easier numbers, eh?
No, that's good. I can do these
You can
numbers.
do this? Yeah.
70% of 20%, so that's going to give me 14% plus 30% of my 10% of my New Zealand dollar exposure. So that's going to give me a combined return of 17%. Not quite the full US dollar exposure, because I've got a little bit of New Zealand dollar exposure in there, but I'm not kind of fully exposed to the New Zealand dollar.
And this speaks to this strategic bit, doesn't
That's
it?
a strategic conversation, right?
Yeah.
And that's a big piece that we review every 6 months, and going, actually, how important do we think currency hedging is? Because unfortunately, New Zealand dollar is one of the more volatile currencies out there. And what we know is that by not taking that, making that hedging decision, we're adding a whole lot of volatility into people's portfolios, which kind of should not create any long-term value, because the theory is that currency is neutral over the long run.
That's right, yeah.
And so if we're adding a whole lot of volatility for no more upside, that's just going to scare people, and we don't see that as a great outcome for customers.
Yeah.
So that's why hedging and currency, that's decision number 3. And then decision number 4 you make is individual stock selection. So we take the view that, and research shows 95% of the return is delivered by those first 3 conversations.
Yeah.
And so therefore that last tiny bit of individual stock selection and tactical selection.
That's only a very, very small.
A very, very small piece, right?
Interesting.
And what's also interesting is where the fees lie in the industry.
That's exactly what I was just going to go is like, hang on, because in my mind I'm thinking, well, it seems to be portrayed, whether it's explicit or not, it seems to be the message is pay us a higher fee because we're busy doing the thing that makes the biggest impact, which is individual stock selection. That's not necessarily the case.
No, and that's the thing, right? Most people will take, so the fees for managing an individual, like say a New Zealand equity fund, right? Where you've got your asset allocation is sorted, your currency is sorted, your regional diversification is sorted. There's only the only decision you have to make is stock selection, right? Yet that fund is often more expensive than a broader holistic growth fund, which needs to make all of those different decisions. So what we've taken the view is that actually by focusing our resources and attention on those things that really make a difference and those things that matter, we can offer a significantly lower cost product to our customers. That's why our funds are 0.63% versus the market sitting at kind of the average growth fund at 1.2 to 1.3%. And we help people where it matters versus doing the sexy stuff. Yeah. But actually the sexy stuff probably doesn't add value, and if anything is more likely to cost money.
It's the whole Pareto principle, isn't it? It's the 80-20 thing, right?
Completely.
So you're trying to drive 80% of that benefit from the 20%, or in this case.
Yeah, and so our view is, look, the upside of actively managing is going to be limited. Is negligible.
You're trying to optimize a very small
look, actually, the problem is even the theory shows and the evidence shows there is no upside to managing it actively. Yeah. And the 60 points or the 0.6% that it's going to cost you to do that is going to be an extra cost, right? So you're hit with often worse returns, not always, but often worse returns, plus a higher fee. Yeah. It just doesn't make sense. I'm biased, but that's...
Well, of course, but it's like, again, you can mix and match these strategies, right? And if you had a core satellite approach to looking at this and your KiwiSaver was part of your core, of course you want that to be low cost, well diversified, and passive sit and forget.
And look, if you are someone that wants to be, there are benefits to being highly engaged in your financial decisions, and that's why. So if you're someone that goes, well, I'm going to be really actively managing it, at my own level. So I'm going to be reviewing my KiwiSaver fund manager every couple of years and going, do I think they're still good? Do I think I want to move them? Do I understand how they've generated the solid returns over the last couple of years? Do I think that's a strategy that's going to work in the next couple of years? Yeah. If you're willing and able to do that kind of analysis, great. But that means you're actively managing your funds and your fund selection.
Right.
And that's a very different approach to kind of trusting someone and kind of just saying, cool, we're just going to leave it alone, because what we do know, a strategy that performs in one market will not perform in the next market.
And there's obviously the mixing and matching approach as well, where you could have an active strategy using passive tools, or passive strategy using active tools. So we've kind of already indirectly spoken to that, so we don't need to revisit that. But I guess it just goes to show that sometimes it's not either or, and sometimes it's not even both. Sometimes it's a
there's an often blend, right? Yeah. And so I go back to the New Zealand super model. So NZ Super, their approach is they take an active approach in New Zealand, because there's a view that New Zealand is an inefficient market, and therefore you don't have the information availability and the high degree of trading, which you have overseas. Yeah,
which kind of makes sense. I get that.
Makes sense. So they manage New Zealand actively, and then internationally they manage it passively. Yeah. They also have some private investments, which are very much an active approach. Yeah. But then they have a relatively static asset allocation. So again, you'd argue that their approach to asset allocation is also passive. Yeah. And so it's a little bit of a picking and choosing which parts they think make sense given the different market dynamics. I'm sure if the New Zealand market, if we saw another 60 companies list in the next 2 years, NZX would all of a sudden be worth something. Yeah. But more importantly, you'd start to see some increased efficiency in the market as well. And they might kind of change their views. But it's a really good example of someone that's kind of not being religious about the approach, just picking and choosing what works in different styles, different approaches.
Okay, so I think that pretty much wraps it up for this one. Like I think we've covered everything. Yeah. I don't think it's a case here of trying to convince people that passive is better or active is better. It's just understanding the differences, and especially in the context of KiwiSaver, understanding why it's important to actually actively think about this
completely
before just taking whatever someone has sold you or whatever you've signed up for by default. This should be part of the consideration when you're reviewing.
It should be part of the consideration, and it should be an important part of what you're looking at. And generally, the fees are an obvious giveaway on the structure. So not always. There are some passive providers in the market that are charging over 1%.
Yeah.
But then I think, again, as you're looking through, the one thing I would always suggest to someone when they're thinking about their KiwiSaver is, first and foremost, get your asset allocation right. Yep. Second thing you want to think about is the fees. And then the third thing, well, I think sustainability is actually, it also needs to be in that mix.
Okay.
And what are the ESG principles, and is that something you like? And it aligns with you. And then the fourth thing should be returns. Okay. And as you're thinking about the returns, that's when you kind of start to think about the active passive. But just be really careful. If you're choosing an actively managed fund just because they've outperformed and they've done really well over the last 12 months or 24 months, make sure you understand why.
There's reasons why.
There are reasons why, right? If someone's delivered 30% when the markets are up only 10%.
Correct. There will be a reason why.
There is a reason why they've done something, and they've done some amazing work to deliver that. But there will be a flip side to that at some point.
Okay. I want to talk to you more about ESG, so we'll save that for another episode. Yep. But for today, that's enough, Rupert. I've had enough, Rupert, for today. You've had enough of me, I'm sure.
I enjoy this. We can keep yarning forever.
I know. Well, yeah. Okay. So, and on that though, like, if for listeners who are listening in, we've tried this out probably a couple of times by the time this comes to air. If people are on the Clubhouse platform and they want to tune in to the NZ Everyday Investor every Wednesday at 5:30, we're going to be trying this for a while. We'll just be having a conversation, and we'll be picking apart a news topic of that week. Don't normally cover current events on this show, but that's going to be something that we're going to experiment for a bit. So if anyone wants an invite to Clubhouse, they can hit me up on Messenger. I've been dishing out these invites left, right, and center. Do that, because I think that's going to be another perspective that we can share.
And I think that's for people that are going to be wanting to do stuff, get more involved, and particularly if you like the active approach. There's a whole lot of really interesting stuff happening in the finance world at the moment, and that's stuff that
Yeah.
Darcy and I always ring each other up and want to talk about, so we'll share it with you guys as well.
Sounds like a plan. Cool, man. All right. Enjoy the rest of your day.
Thank you. You too.
Thanks again.